Alright, welcome back to my YouTube channel, Studying with Clef. My name still remains Caleb, and today we'll be talking basically on IAS 40, another type of non-current assets. So IAS 40, which is investment properties. So like we discussed last class, that we have several standards governing different types of non-current assets. We did IAS 16 last class, and this is IS 40 now, investment property, which is another type of non-current asset. So we'll be talking about the definition, about the recognition criteria, we have the measurement, we have uh, the reclassification, and we have the disclosure requirements. I will take an example to illustrate this things. Example. So IS40 prescribes the accounting treatment of investment properties. So investment property, like we talked about last class, it's a type of non-current asset which are specifically governed in another type, basically different from IS 16. So while IS 16 was asset or is asset held for use and administrative purposes, IS 40 investment properties are basically, so coming to the definition now, so these are assets held to earn rental income, and for capital appreciation purposes. Or in some cases, maybe for both. So basically, IS 40 is just relating to some types of assets, which includes land and building. So these are examples of IS 40, which is investment properties. It's not limited to this, but these are the most important type of investment properties, which is land and building. And in some cases, it may be part of land and also part of the building. We'll talk about that subsequently as we proceed. So IS 40, we say assets held for rental income and for capital appreciation, meaning that without this scope, any other asset held for any other use out of this definition should not be regarded as an investment property. Just like we said last class that IS 16 are assets held for use and for administrative purpose. IS 40 investment properties are assets held to earn rental income and for capital appreciation, or in some cases, you may hold them presently for future capital appreciation or to regard them as investment property later on in the future. So just like we have it here, land and building are examples of investment properties. So part of land can be regarded as IS 40, and also we may have a building. I'm just trying to explain this better so that we get the concept. So for example, we have a big building where we use parts to we use parts as uh, administrative. We use parts for administrative use and also use another part for investment purpose, like for rental and the likes. So we can classify that building as part of the investment property if there's only a condition, if the portion or the proportion apportioned for rental purpose is higher than that of which we are using. Meaning that if that building, we use a smaller portion of it for administrative use and use maybe about 70%, for example, we use 70% of the whole building for rental purposes. So I'm saying that either land and building, we have cases whereby um, we may be using a building, the company may be using the building and may also use it as rental for rental purpose. So land and building, which is part of investment property. So this may be divided into, if the proportion we are using for administrative purposes is 30%, admin purposes, and then we use 70% for rental purpose. Then this can be classified as investment property. So far, we are using larger portion of the building for rental purpose. That's for investment purposes. So that's on one side. This is just the definition of investment property and what it relates to, basically. So the recognition criteria now. The recognition of IAS 40 is similar to that of IAS 16, which is property, plant, and equipment, which states that before you can recognize an asset as an investment property, it must be probable that this asset will generate future economic benefit. So it must be probable that the assets can generate future economic benefit, just like IAS 16. And also, it must be reliably measured. So unless these two requirements are met, then an asset cannot be classified as investment property. Don't forget, if for example I have a building which I cannot actually state that will generate future economic benefits, then it is not considered as an investment property. Remember in the previous classes, we talked about IS1 where we differentiate assets, liabilities, income, revenue, and expenses and equities. So you understand the conditions for you to be able to recognize assets, liabilities. So just in case you missed those videos, you can relate or refer back to them. So here we already have the recognition criteria for recognizing investment property. So unless an asset can generate future economic benefits, then it should not be classified as investment property. Then secondly, it must be reliably measured. If I cannot place a value on a particular asset, then I should not consider it or classify it as an asset or as part of an investment property. These are also the two recognition criteria for IAS 16, which is property, plant, and equipment. That the same thing, both of them are non-current assets, but now we're trying to differentiate types of non-current assets. So we have many actually, which we've talked about one last week, last video rather, and last class. And now we're talking about another this class. So that's for the recognition criteria. The measurement also very similar. in nature to IAS 16. So measurement, let me see if I can manage this. Measurement. We have initial measurement and secondly, subsequent measurement. So initial measurement, just like I've explained, all of these are still relating the same as IAS 16. So I don't know, you may also need to look at that so that you'll get more understanding. But initial measurements are just what you recognize as assets, basically as investment property in this case, as investment property at the initial stage. That's as at when you acquired this. When you acquired that asset, how do you recognize it? How do you place it in your financial statement? We also discussed that in previous videos. And subsequent measurement is how you recognize this asset after that's passed an accounting period. Just like we said that non-current assets are assets which are held over an accounting period, that's over 12 months. So subsequent measurement after it has passed its first year or second year or third year, depending on the useful life of the asset, is what we call subsequent measurement. How do you recognize them in your financial statement? Basically, in your statement of financial position, that's under non-current assets. So that's initial measurement and subsequent measurement. So initial measurement, just like IAS 16, is to be measured at cost. So investment property initially should be measured at cost, while subsequent measurement, just like last video, should be measured at, this is at cost, while subsequent measurement is divided into two, which can either be cost model, just like that of IAS 16, and secondly, fair value model. Remember, we said that fair value has a standard of its own, which is IFRS 13, which we are also coming to give more light on it. Just like I've said, fair value is just like the present value or the current value or worth of a particular asset in the market. Just as a layman understand. When we get to the standard, I'll shed more light on fair value because it has lots of components too. That's why it has a standard on its own. So what this thing actually states in the market, that's exit price. But when we get to fair value measurements, that's IFRS 13, we'll talk about that in details. So we said subsequent measurements, IAS 40, investment property can be measured using cost model or fair value model. We talked about the costs at initial stage, what you classify as part of the cost of the asset when we were doing IAS 16, that's property, plant, and equipment. Said costs does not only include the purchase price. We also have additional costs which can be related to this cost. That's transport cost, site preparation, every other on borrowing cost, dismantling cost, and likes of such. So that's part of component of cost. In case you missed that, refer back to IAS 16. You have the component of cost under IAS 16. So subsequent measurements now, we said we can either use cost model or fair value model. Cost model, just like PPE, is still cost less accumulated depreciation, less accumulated impairment losses. That's for cost model. The same as that of IAS 16. Cost minus accumulated depreciation. We define depreciation, define depreciable amount in our previous class. So you may need to just get acquainted to these terms and ideas so that you can flow with this. Then fair value model, like we also explained. So we said the cost model is the cost, which we also said has some other components which we've talked about, less accumulated depreciation and accumulated impairment losses. So that's for subsequent measurements. That's the first one. Then secondly, we said we can use the fair value model. Fair value model. So if fair value model is used, there are some things that must be put into consideration. One of them is that the asset must be tested for revaluation, must be revalued at the end of every accounting period. So we must revalue the asset at the end of every accounting period. Valuation at every accounting year end. So that's one of them. Secondly, all gains or loss on revaluation must be taken to the P or L account, which is the same thing as the income statement. So the first of them is that you must revalue this asset at the end of every accounting year, every accounting period. Then secondly, gains or loss on revaluation must be taken to profit or loss. So lastly, the asset must not be depreciated. As it stands, assets must reflect their current worth at the end of all accounting period. If we are revaluing an asset at the end of the accounting period, meaning that, for example, if I'm saying that as at, for example, as at 30th June, let's assume 30th June is the end, accounting year end of a particular company. As at 30th June, investment property, which is land or building or anyone as the case may be, investment property of a company is revalued. We'll take an example, so we'll see how all of this work is revalued to since 30th June is the accounting year end of this company, and as at this same 30th June, this asset was revalued to 200 million. It means it cannot go above 200 million as at this date, and it cannot also go below 200 million. So meaning that as at this current date, this 200 million must not be depreciated. So it will reflect only this 200 million in the statement of financial position. So if, for example, the previous one was, let's say, as at June 2021, for example, that's the current year, we said this asset is revalued to 200 million. If as at 2020, that's previous year, as at 30th June 2020, this asset had been 150 million. If this asset had been 150 million as at the end of 30th June, right, it means there's a revaluation surplus of 50 million, which must be charged to POL account, just like we've talked about. Then we said this asset must not be depreciated, so it has to reflect 200 million at the year end of all accounting period. That's 200 million is just an example. So it must reflect the current worth, which is the fair value or the revalued amount at the end of each accounting period. In some cases, when we get to impairment, we talk about recoverable amounts, which was also explained, must show the recoverable amount at the end of each accounting period. So that's for that. Then that's for measurement. Reclassification now. Reclassification. Reclassification. They said assets which had been previously recognized as investment property, meaning that we are using this building for rental purpose, but we want to change it from rental purpose to using it for the company. So investment property, we can have investment properties converted to or converted for company's use, which will no longer be recorded under IAS 40, but will now be regarded under IAS 16. So it was moved from IAS 40 to IAS 16. That's one. We can also convert investment properties, which is IAS 40, can also be converted, investment property converted for sale. Meaning that instead of holding it for rental purpose or for capital appreciation, we want to be selling them. So it becomes IAS 2 in this case, which is inventory. So like we said, investment property can be converted from IAS 40 to IAS 16, which is for companies' use, and also can also be converted from investment property, which is IAS 40, for sale. So if we convert our lands, which we are actually renting out to people, or buildings that we've been renting out to people, any rental income, we now want to be selling them. So that land or building becomes our inventory, which is governed under IAS 2. We'll still look at IAS 2, talking about the measurement and the likes of such. We've talked about IAS 16 and everything it contains. So we should no longer record this thing under IAS 40, but should now be regarded as an IAS 16 item, which is property, plant, and equipment. So that's that. In some other cases too, an admin building or a company used for company's use, a building used for company use can be converted to investment property. So it means we can convert from IAS 16 to IAS 40 and the other way around. The same way, we can also convert from IAS 2, which is asset held for sale in the ordinary course of the business. We can also convert it to investment property. Instead of selling them occasionally like we usually do, like the company's nature, we now want to be holding them for capital appreciation or for rental income, rental purposes. So that's reclassification. We will reclassify them from the previous accounting standard, IAS 40, to either IAS 16 or IAS 2, and vice versa. So the next one is our disclosure requirement. So that you note this, the disclosure requirements. So an entity must disclose certain things relating to investment property in their financial statement. Just like we said that we have 5 components of financial statements in the first class where I explained these things. Some of the notes to the account under the components of financial statements, remember there are 5: statement of profit or loss, statement of financial position, statement of changes in equity, statement of cash flows, and notes to the account. So under the notes to the account, which we talked about, relevant notes, financial or non-financial, which may be relating to the financial statement prepared, is also part of financial statement anyways. So this disclosure can be part of the notes to the account. What users of this financial statement should actually know is what we regarded as what we record under disclosure requirement. So disclosure requirement under IAS 40, the entity must disclose the models used. You must disclose whether you are using cost model or you are using fair value model. That's first. So if you are using cost model, so it must disclose whether it is cost model or fair value model. We've discussed each of these things. So if you are using cost model, you must disclose the depreciation method or the depreciation depreciated amount of this asset. So you must disclose the method of depreciating your asset. Just like we discussed under IAS 16 that we have several methods of depreciating assets, which is straight line, sum of the year, and the likes of such. So reducing balance and many like that. So you must disclose the depreciation method of depreciating your properties. That's if you are using cost model. Now, if you are using fair value model, you must disclose the fair value of that asset at that particular year end. You must disclose any gain or loss on the revaluation of that asset for that particular period. Then you must disclose if all transactions have been taken care of. So that's cost model. So we must talk about the accumulated or the depreciation method. So this relates to this. Then this, you must disclose the fair value itself, like the current worth of the asset at the year end, the fair value. You must disclose any gain or loss on revaluation on this asset. And that will be that. So that's for the disclosure requirement. And then we have an example to talk about or to solve, which will be displayed on the screen. I have an example here, and I'll read. Sekibo PLC had also purchased an investment property on 1st November 20x8 for 56 million dinars. At 31st October 20x9, the investment property had a fair value of 48 million dinars. The company uses the fair value model in accounting for investment properties. Now, Sekibo PLC wants to advise on how to treat these transactions in the financial statements for the year ended 31st October 20x9. So just to demonstrate all we've been talking about, so Sekibo PLC. We're told that this company uses fair value model. So on 1st of November 20x8, this company has an investment property of 56 million dinars. Sorry. So as at 1st of November, the value of this investment property is 56 million dinars. Now, as at the year end, at the 31st October 20x9, remember that I said that if you are using fair value model, you must revalue your investment or your property at the end of every accounting period. So as at 31st now, from 1st of October 20x8, the next accounting period or the accounting year end for this date will be 30th October. So it becomes a year on the 30th of October 20x9. So as at this period, the value of the investment property is now revalued to 48 million dinars. So in this case, there had been a revaluation loss instead of a revaluation surplus. So there had been a revaluation loss from 56 million to 48 million. So we'll have a revaluation loss, just like we said that all gains or loss on revaluation of investment property must be taken to income statement, that's your P or L account, which we've talked about. So revaluation loss will be 56 million less 48 million, which will give us 8 million. So 8 million is the revaluation loss on investment. So how do we correct this, or how do we show this 56 million to reflect this revaluation loss of 8 million? That's more like passing the entry. And when we were starting this class, I explained that assets have debit entries. Income credit entries, liability credit entries, equity credit entries, and expenses debit entries. So I hope you can remember. In case you can't remember, you can just go back to previous classes so that you can understand better. So to pass this entry, we are going to debit the income statement, which is P or L, with revaluation loss of 8 million. So we'll take this as an expense to profit or loss account. Then we'll credit. Remember that we said expenses have debit entry. So if I'm debiting 8 million to expenses, it means I'm adding 8 million as part of the expenses. And I'm crediting the investment property itself. Remember that we said investment property are non-current assets. So they are assets, and assets have debit entry. So we're crediting investment property with 8 million. So if I'm crediting investment property, it means I'm deducting from 8 million from investment property. I am adding 8 million to expenses in the income statement and deducting 8 million from investment property in the statement of financial position, as assets are recognized in the statement of financial position. So that's for that. It means that this 56 million as at the year end now will now be 56 million, since we are crediting investment property with 8 million. It will be 56 million minus 8 million, which will now be reflecting the current value as at the year end, which is 48 million, which will state that the fair value of the asset must be reflected at every accounting year end. So this brings us to the close or to all about investment property. So we've talked about the definition, the recognition criteria, the measurement, the cost model, or initial measurement, subsequent measurement, which can be either cost model and fair value model. Talk about the reclassification, where you can reclassify from investment property to property, plant, and equipment, that's IAS 16, and vice versa. Also from investment property to uh, asset held for sale, which is IAS 2. So, and also vice versa. You can do from IAS 2 to IAS 40, IAS 40 to IAS 6, or to IAS 2, either ways. So, disclosure requirements, we've also talked about that the company must state their uh, models for measuring investment property. Either it is cost model or it's fair value model. And if it is cost model, we say you must state your method of depreciating your asset. And also if it is using fair value model, you must state the fair value at the end of that particular period of that asset. Then you must also state your method of revaluing this asset. And lastly, you must also disclose your rental income. If that building or land was held for rental income, meaning that you hold it to be receiving rental income, you must disclose the rental income gotten from such investment property. So in case there is any question or any part that is not clear with this, you can reach out through the comment section. And I hope you've been able to understand IAS 40 basically. So in our next class, we'll be talking about IAS 38 and to shed more light, which is also part of a non-current asset, which will explain better and will get better. Just flow with me. So this ends the class. In case of any other thing, my name still remains Caleb, and this is Study with Clef. Thank you. Please like, share, and subscribe. There's so many people that may actually need to see this. Please share to as many as possible people. Thank you very much.